please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
First trade is only 0.2 higher on the Nifty and 0.3 higher on the Nifty banks.
You will still see a lot of buoyancy in IT. In fact, if I may say so, it's the large caps which should now sustainably outperform.
Affordability in the housing space from a consumer point of view has been really improving.
TCS has enormous potential, and the digital transformation was only going to accelerate the market potential for TCS.
65 points in the Nifty is nothing but good. 10,629 is where the Nifty stands.
Lots of buying on the NBFC side. The stock of the afternoon perhaps has to be Cholamandalam. We're talking about a 9% up move, and it took its peer Shriram Transport Finance up with it as well. So that's Chola for you after the blowout numbers we've seen in Q4. Let's pull up Shriram Transport. So that had a bit of a rub-off effect going as well.
Market slips from highs to close with only minor gains. Nifty slips below 10,600. Sensex gains a modest 35. Midcap index outperforms.
TCS becomes the first Indian company to cross the $100 billion mark in market capitalization, even goes past global giant Accenture, albeit briefly.
Midcap IT stocks end marginally off day's high in the last hour. This as the rupee continued to tumble, hitting fresh 13-month lows against the dollar.
Oil marketing companies remain unruffled in trade even as crude prices continue to rise. Petrol and diesel prices are now at their highest level in over the last 4 years.
And US bond yields inch towards 2.99% after the Friday close of 2.96%. Global equity markets remain jittery on fears of the higher cost of money. Well, those were the top 5 headlines from a day's trading action, which will be remembered for a long time for TCS hitting the $100 billion market cap. Hello and welcome to Markets Today Talk Back, the show where we are going to tell you all about 8 hours of exciting market trading in just 5 headlines. I'm Lata Venkatesh. With me, my colleague Ekta Batra. Hi, Ekta.
Hi, Lata. Absolutely. Well, over the next 30 minutes, we will be discussing those top 5 market headlines, and our experts will also be answering your stock queries. Joining us to answer the stock queries is Dipan Mehta, member of BSE and NSE on the fundamentals, and technical expert Ashwini Gujral. Thank you, gentlemen, for joining in. Well, before we get to solving all of those queries, Lata, I wanted your take on how exactly the markets fared. What a fabulous day and momentous day it really was for TCS.
Oh, yes. I think ultimately that's what we're going to remember from the day, and we have to tell our viewers that today will be TCS day, albeit a lot of the gains were sacrificed to profit-taking by end of day. What else was important in the market? The most important theme in the market or markets globally has been the US 10-year bond yield going towards the 3% mark. This US will be touching 3% after something like 4 years. Now, this is important because, this is the most risk-free rate of money in the world. And as that starts, becoming expensive, that indicates that money has become expensive. All global markets will have to wait and watch and see what the impact is and see if any bubbles anywhere will get burst. Concomitantly, that pulled up the US dollar, and the rupee hit a fresh 13-month low. Obviously, because of that, you saw IT stocks have a further spring in their step. They have been moving on the rupee and the global growth themes for a goodish bit now, and today there was that additional positivity coming also from TCS with that big stock, the biggest bellwether of the IT sector, hitting that $100 billion market cap. There was bonhomie in that IT sector, but there were enough biggies who were pulling on the other side. You had FMCG and private banks, the two big heavyweights in the index, not firing at all. HDFC Bank, after a decent set of numbers, though I would squabble a little about the loan growth, that one saw profit taking. Even NBFC companies, Indiabulls Housing, after a good set of numbers, saw profit taking, but you still had the gainers. PSU banks, probably the ones that did not gain at all through all this recovery in the markets. That one saw a bit of short covering. And of course, Midcap IT was there. The important theme perhaps will be Nifty still struggling to cross 10,600.
Yes, absolutely. Well, let's see whether we manage to surpass that mark. But just to give you a sense in terms of the stocks that were in focus today as well, well, like Lata mentioned, it was all about the IT space. So TCS, just a quick mention, up around 0.2%. TechM was off the day's high along with TCS and HCL Tech as well. Otherwise, a lot of the pharmaceutical companies probably saw some amount of momentum because of what we've seen with IT. So Cipla, Sun Pharma, Lupin, all of these stocks saw a late surge today. IndusInd Bank, Yes Bank, ICICI Bank, a mixed performance really which came in from the private banks. Indiabulls Housing and HDFC Bank, like Lata mentioned, were a couple of result reactions that we saw, both of them going home in the red. And from the broader markets, there was a lot of action from the results stable. So Cholamandalam, which was up 6.5% odd, Saskin up 16%, Unichem on the back of positive news coming in from the US FTA also saw a good amount of momentum. On the downside, something like Bhushan Steel and Monnet Ispat were a bit sluggish, Lata.
Okay. Well, straight away, let's get to our guests. Ashwini, first up to you. The inability to cross 10,600 should be treated as significant?
Well, the problem is that even if you do cross, the progress may be fairly slow, because if banks don't participate, there's only so much IT can do. Reliance tried to participate, didn't really go anywhere. So it's very clear that the banks are going to chop around while IT has a tailwind. So with that, maybe Nifty will be a lot slower in the move ahead. That is a problem when you are crossing key levels. But the sense is it'll take some more time, and maybe it'll take 1 or 2 good days on the bank Nifty because of some reason, crude coming off, yield coming off, something for that level to be crossed. Otherwise, next few days would still be in the range, because IT, after its run up, probably could consolidate for a couple of days before we move forward. But overall, the market looks strong, and bad news is impacting it far less than the good news.
Okay.
Okay, well, let's get to the second headline of the day then. TCS today became the first Indian company to cross the $100 billion mark in market capitalization. The tech giant has taken around 14 years since its listing in 2004 to achieve this milestone. Also, with this surge in the valuation, the Mumbai headquartered tech giant has raced past the global consulting services leader Accenture, albeit that took place briefly. Here is what Tata Sons chairman N. Chandra, who spearheaded TCS in its formative years, had to say on the company achieving this feat.
The digital transformation is going to be the biggest opportunity, primarily because there is going to be more technology in every industry, whether it's a B2B industry or a B2C industry. So we have been making these commentaries and also parallelly investing and building capabilities and being ready for this adoption cycle. And this adoption cycle is gaining momentum. And I mean, if I may say so, I think it's the start of the next big run for TCS. It's a very special moment for all of us, and I'm extremely proud. And I've always maintained that TCS has enormous potential, and the digital transformation was only going to accelerate the market potential for TCS. Technology adoption, especially in the digital domain, is picking up mainstream. I've always said that the delay is because of a number of factors. It's not only the capabilities we have, it's also the readiness of the clients, and all those things are coming together.
Okay, well, we have a question from S.A. Syed, and there are zillions who will actually want answers to this question on TCS. Syed says he has 150 shares of TCS which he bought for over 2,300 rupees and has been holding them since a year. Says he's a long-term investor, wants to know if he should hold or sell them. Well, Deepan, your thoughts? You've long been a watcher of IT. Now there seems to be a wind in the tail with both rupee and global growth firing. Your thoughts on TCS itself?
And Lata, I think I've been tracking IT now for almost 20 years or so, and most of the time I've got the IT stocks right, but I think last year last few months or so, IT shares have done exceedingly well. You've seen a good trading bounce, almost 15 to 25% or thereabout. But I'm still not convinced whether these are great long-term investment stories as well. No doubt TCS is a great company, but I'm not that enthused when they say that they can grow barely at double-digit growth rates, and rest of the industry is struggling to grow even at single-digit growth rates. The typical companies that like to invest in have at least revenues, earnings per share growing at 15-25% or thereabout. And there are many such companies in large cap, mid cap space which investors should prefer over the IT companies. And the re-rating of the price earning multiple, I think that more or less over and done with. So I'm not that optimistic on IT companies, even TCS. And the investor is a long-term investor, he's invested for a year or so. Maybe you should book out the profit over there and look like getting into some of the banks or some other consumer-oriented stories. So I'm still not positive on IT. I don't think there's visibility beyond maybe next 1 or 2 quarters or so. And again, maybe after that period, the IT companies may be struggling for getting the growth going. So not optimistic on TCS even at these price levels.
Okay. Ashwini, what would you recommend for to our query on TCS, as well as your thoughts on TechM? If you had to choose between the two technically, if you see TechM, it's actually outperformed TCS year to date.
See, TCS is a larger company and TCS did not get as beaten up as Tech Mahindra. Now my sense is, news is good and bad. It all depends on what kind of weightage the market has on a certain stock. Tech stocks are moving up because everybody had, sold them, and now they are, going overweight on those stocks or increasing weightage, and some money is coming out of banks. So this is the first quarter when something has happened. So there could be more ahead. Typically, a person like me would add here, and when this becomes a mainstream story and everybody has tech stocks, that is a time where you exit 3-4 quarters of good results, etc. I think that sort of period may be beginning. Plus, the way rupee is going, it's already 66.50. I think the tailwind is here. It's not. I don't think it's in banking. So if it's not inward-looking sectors, then it's the export sectors. On Tech Mahindra, I think we should get fairly close to previous high, about 750, and at some point that 750 zone is likely to get taken out. But particularly it's smaller stocks like Mindtree, NIT Tech, etc., they would give much better returns.
Oh yes, and that's the set of stocks that we're going to concentrate on. Our third headline for today. Midcap IT ended marginally off the day's high in the last hour of trade as some stocks saw profit taking, but through the day they surged due to a cheer in the IT sector thanks to TCS and a weak rupee, which slumped to a 13-month low. The rally was led by the likes of NIT Tech, Sterlite Technologies, I think it's L&T Technologies, not Sterlite, and of course Mindtree as well, that Ashwini was talking about. I think we have a question tweeted to us. Nathaniel has tweeted to us that he has 1250 shares of Mindtree, which he bought at 470 rupees. And he wants to know if he should hold or sell. Deepan?
Well, I think whether it's large cap IT or mid cap IT, our view, medium to long term view remains negative, and there's a nice trading bounce taking place in the company. So investors who have already invested at lower levels can certainly look at paper profits at this point of time, but they should be quick to book it as well. Maybe look at the technicals to see if these companies have got some more steam to go up. But by and large, I remain pretty pessimistic on the prospects. It's not that these companies will suddenly collapse or they will face problems as far as growth, as far as revenues and profits are concerned. My issues are more with the long-term growth rate of the sector as a whole. And as I said, I think investors should prefer higher growth companies than IT. And a little bit benefit may come through from the rupee, so you may have a couple of good quarters or so. But there's not much visibility beyond maybe a year or so for these IT companies. So I would say book profits in Mindtree, move on to the banks or consumer-oriented stocks. Could be auto, could be appliances, could be entertainment, hospitality. I think there are many segments, domestic-oriented, which can offer very good returns. And this earnings season may turn out to be very good for these domestic-oriented businesses as well.
Okay. Well, that's one point of view, but there is a rising point of view that IT is the place to be. Global growth is finally turning in favor of the Indian IT space as well. TCS did tell us that even BFS, banking and financial services, an important vertical for them, will start firing in a quarter or two. They seem confident. Retail already has started firing, and it's showing up in stock prices. So clearly, at the moment, it's the IT bulls who are outnumbering the IT bears. We'll take a break on that note, but do stay tuned. Our experts are going to continue to be with us to answer all your questions. We're back in a jiffy.
Welcome back. You're still with us on Markets Today Talk Back. We have Ashwini Gujral and Dipan Mehta who are here to answer all of your stock questions. We're through with the first three headlines of the day. So let's get to the fourth headline now, which is on oil marketing companies, which have remained absolutely unruffled in trade today, even as crude prices continued their up move. This is as a result of passing on the volatility of crude prices onto the product prices, which are now at 55-month highs. Remember, petrol will now cost you 74.4 rupees a litre, while diesel will cost you 65.65 rupees. In fact, Sonal is here to give us more details on this. Sonal, over to you.
Well, that's right. OMCs were buzzing in trade today despite rising Brent crude prices, and one of the reasons could be because fuel margins for these companies are remaining robust despite the higher prices. That is because the companies have been able to rise the prices consistently, and now we can see that petrol and diesel are at the highest levels ever in last 4 or 5 years. Now, by end of fourth quarter FY18, we could see that the margins rose to 3.8 per litre for diesels and 3.4 per litre for gasoline. This is in comparison to 1.8 to 1.4 levels that we saw in the first half of fourth quarter FY18. Now, retail fuel marketing margins for OMCs right now are above their normalized levels, which is quite positive for the companies. And if we see the revenue stream, 50% of the revenues come from diesels and petrol, and that's why it's very positive for OMCs. So despite rising crude prices, OMCs were buzzing in trade today.
Thank you very much for that, Sonal. So with such hefty margins, much higher than even their own average, even a little bit of taking the burden of the consumer on them won't hurt. At any rate, at the moment, the government seems to be allowing them to pass on higher raw material prices onto products. We've got some shareholders of oil marketing companies speaking to us. Vijay Kumar has written to us. He has 290 shares of HPCL at 415 rupees, has been holding the stock for 5 months now. He wants to know if he should hold or sell. Well, 5 months now looks like at the moment short term, but what would you advise him, Deepan?
I'm not that positive on the oil marketing companies as well, and at some point of time they will face the pressure in terms of passing on increases in case crude goes to higher from these levels, and there are forecasts of $80, and then once it reaches $80 then the forecasts go to $100. So I'm not that positive per se on oil marketing companies. In any case, I think even accounting for the kind of position they are in when it comes to passing on price increases, there is not that much of volume growth taking place in the products. So it's going to be a bit of a challenge for the oil marketing companies to grow their revenues and profitability. No major expansion plans also going on stream. So you look at the whole picture, you get the impression that we are investing more or less in a utility type of a business where there's a great deal of government interference. So that's not ideal for minority shareholders. I think it's best to move away from the oil marketing companies. You could look at a trading bounce to exit from these companies.
All right. Ashwini and Deepan, we will thank you on that note. But viewers, do stay with us because the last line is something which is perhaps going to be with us for a long time. US bond yields inched towards the 2.99% mark today after their Friday close of 2.96%. Global equity markets have obviously been a little jittery on fears that the cost of money is going to rise and easy liquidity will be at an end. At the moment, if they hit 3%, US bonds will be at their highest level since January 2014. And if they were to move to 3.04%, then they will be at the highest level since July 2011. So we are talking about a near 7-year high on US yields if they were to go to 3.05. That's another 5-6 basis points. We are joined by Nick Parsons, founder and managing director at Simply Macro Strategies Research. Good afternoon to you, Nick. Thank you very much for joining us. Tell us how an emerging market investor should look at US yields touching 3%.
Well, good afternoon from London. It's always a pleasure to be on your show. I think an emerging market investor should look at these with a great deal of because of the level of bond yields, but also what's happening to the US dollar. And it's that in turn which has got the potential to cause a bit of an upset in EM from current levels. If we look at the dollar index against a basket of major currencies, it's just had its biggest 3-day rise for almost 2 years. If we look at dollar rupee, what are we at? We're nearly at 67 at the moment.
Yes.
And that in turn is the highest in more than a year.
Yeah.
So I think the strength of the dollar, which results from those higher bond yields, is something that we might begin to have to fairly quickly factor in when we look at emerging markets from here.
Okay. Typically, how will it play out? Will it mean people will pull out money from emerging markets? Because with a mix of stock yields getting reduced by the dollar earnings, are we likely to see withdrawal of liquidity from emerging markets?
Yes, I think it's quite possible that we do. I mean, if we look at the Nifty, it's back at levels that we haven't seen since almost the end of February. So we're at a 2.5, nearly 3-month high there. There have been some very, very good gains registered over the course of the last 4 or 5 weeks. I mean, if we go back to the last week in March, as you well know, we were 9,800 on the Nifty, and here we are now 7 or 8% above that level. So there are some decent profits to be taken. And for me, it would be no surprise for the first time in this cycle and for the first time for several weeks, just to be sounding a word of some caution here, and because I think there's the potential, at least, for a sell-off, which people had simply not factored in, because a lot of people have been caught unawares and caught by surprise by the strength we've seen of the dollar over the last 3 or 4 days.
Okay. So, Nick, can you give us some levels if you are working with on the US 10-year as well as on the US dollar?
Yeah, sure. For the 10-year, then, as your colleague mentioned, obviously 304 is the very, very big level to watch. But if we look at the dollar index, and bear in mind, we start this week with a market carrying almost record short positions, record levels of short positions in the US dollar. That's against the euro, against the pound, against a whole basket of currencies. Now, currently, we're trading at 90 on the dollar index, which is the highest we've been in 5 or 6 weeks. But if we just stand back and take a bigger perspective on that, it's quite easy to imagine that we go back to where we were at the start of the year, which is 92. And if we look back to late November of last year, we were 94.5. So these are not levels that people have factored in at all into their calculations. They've been taken by surprise. And my sense is that nobody who's buying dollars today is doing so with a smile on their face. They're doing so because they're stop-loss orders which are being executed. And this has got the potential, at least, to get quite ugly.
Okay. Well, if you were to sell, if you have to put a pecking order in terms of emerging markets, would India be high in terms of the sell-off? After all, our current account deficit appears to be widening.
Yes, I think this is just precautionary profit-taking rather than the start of a calamitous decline.
Okay.
But what we have seen is investors becoming much more tactical rather than structural, and certainly tactically it makes sense to lighten up on holdings from here.
Okay, but there is still global growth, and like we saw the results of companies like TCS and other infotech companies, they are participating in that global growth. Wouldn't that make Indian companies attractive, some of them?
Oh, you're absolutely right to point that out, but my suggestion is here we're in for a tactical pullback rather than the start of a 10 or a 20% decline that we all need to go and worry terribly about. But tactically, at least, I think there's a potential for a pullback in the short term.
All right, Nick Parsons, thank you very much for putting all that into perspective. That's right, we haven't seen this kind of US bond yield levels for the last 4 years, if it touches 3%. And we haven't seen a dollar rupee at these levels for the last 14 months. So better factor in all that. We'll wrap up this edition of Markets Today on that note. Thank you very much for watching.